right, good morning, everybody. So, like we usually do, we want to start with things that may have moved around in the overnight hours. What happened in Asia? What happened in Europe? I like to use finance juice for this because it tends to have additional Fed speakers. It makes it easy to kind of highlight what's going on the day. You don't necessarily need an account to finance juice, but I found that if you open a free account, you can use the filter and get rid of a lot of the kind of the fluff pieces of news that really I find distracting. It is CPI data today. Everything is going to be based on this. If it is not absorbed well by the market, then we're going to take a hard move to the downside. If it is absorbed well by the market, then we're going to take a big move to the upside. It really, I don't see any ambiguity there at all. There's no middle ground to this. Everything has been on pause, waiting for this to get started. It's been a muted week, and the market has really done what we expected it to do: hold the line, maintain the range. And that's what we want to, that's what we expected, and that's what we got. Right? So I want to look around, make sure that there's nothing in the overnight hours. The European market wrap I find really useful, a little bit of insight. And you can also go to 5 Things You Need to Know by Bloomberg. It's free. You can get that emailed to you every morning. It's a really nice summary. And oftentimes, I got to admit, down at the bottom, there'll be like a little op-ed, and the person writing it usually has some really good insight on things that kind of go under the radar. Bring it over to Thinkorswim. CPI at 8:30. Business inflation expectations at 10. Petroleum at 10:30. The 10-year note at 1 o'clock. Make no mistake about it, that 10-year note today can be pretty impactful. It can absolutely reshape our trading day. However, if the CPI is really out of whack today, I don't think any of these others are going to do any good. You got to remember, the market's already trying to price in what they think the CPI is going to be. Some of the biggest moves that we could see is if it's really, really far off the mark. Right? If they're expecting like 8.6 or 8.7 and say, just crazy number, it comes in at like a 10.5. Really big, way outside the box, way outside of any of the expectations. We're going to see a drastic move from something like that. None of these others would matter at that point. Same thing on the other end. They're expecting 8.6, 8.7. Imagine if it came in something like a 5. Nothing else would matter today if we had such a drastic miss in the cumulative anticipated numbers. With that in mind, this is the range for today. The market maker move is 0.75%. When you add that to the 21-day ADR, we're looking at a market that can move to 42.32 on the upside without even being considered an extreme move. That would be just like shrug your shoulders, kind of an okay, reasonably decent size move, not out of line whatsoever. It's a 100-point move basically from our current location. If we were to get extreme, it's going to go even farther than that. that's not the extreme read, right? That's the in line with expectations read. 42.32 to the upside. The full ADR alone would put us at 4,200 to the upside. A full ADR to the downside would be 40.57. Add in a market maker move, and it's 40.28. Again, that would just be shrug your shoulders, kind of, another day, no big deal, not out of line, not very big. If we want to measure what an extreme would look like, since we have a market maker move, you would add that to the ADR and then multiply it by 1.5, get yourself 50% more of that. Dollar-wise, that's about a $150 move, right? So from the close, you could just measure up $150, 150 points, and put your line there. Or down 150 points and put your line there. As you would expect, the volume is really light at the moment. Nothing really coming through yet, right? And that makes perfect sense because we're all waiting on the FOMC numbers. The daily pivot and the weekly pivot are on top of each other at this point. We've got a 50% retrace from Wednesday's low to Monday's high. That 50% retrace is basically right where we are, 41.35. So when the numbers come out, it's very likely going to break any near-term pivots. That would be like yesterday's high, yesterday's low. We're going to run right through those like they don't even exist. The previous week high may slow us down a little bit, or, looking to the downside, the previous week's low. I would expect a good 40 to 50 point move before it even starts to stabilize on either direction. The main thing today is, after it makes a drastic move, is it going to reciprocate? What you often find when a market makes a big move, it creates a liquidity vacuum, and then it spends a lot of time resetting that vacuum. Think about last Friday with the job numbers. We had a substantially drastic move in the market. It stabilized, and then it spent most of the morning resetting that gap, working its way back up to where the price was before the announcement came out, and then it sold right back off again. Consider that a gap close, right? It's not a gap, obviously, there's a candle there, but it behaves very much like a gap, right? So when those job numbers came out, beat the market to the downside, ran right back up, basically reciprocating, right? Closing the gap. Today's expected move at the report is very much expected to do exactly what this did. Big, drastic, sweeping move in a single direction. The question afterwards is, do we reset? Do we at least run back up and attempt to reset? That's the wrong one. Boom, boom, boom. Wait. All right. The volume profile right now is really, really narrow, which makes perfect sense, right? Because we've been just kind of hanging out, holding the range, maintaining within this really tight system for a week and a half. This is a 10-day volume profile. There's not many days left, right? It's got Wednesday, Thursday, Friday on it of 2 weeks ago. So as you can imagine, if we break outside of this, which we very likely are going to do when the report comes out, there's no volume resistance to the upside once we get through the peak of 41.88 from the other day, or no volume support to the downside once we get below the value area low. With that shallow value area, we're very likely going to move through there very quickly. If it's an upside move, then we would likely move through that very quickly because there's no resistance there. We can see that we spent a considerable amount of time at 41.52. So there's a lot of TPO, time spent, but not a lot of volume there, right? Not compared to where, say, the point of control is, which is the greatest amount of volume, or at 41.36, which has a significant level of volume. If we didn't have a CPI today, I would focus a little bit more on those greater levels of volume, but once that report comes out, we're going to blast right through any of that, either side, up or down. So we're looking at the 5x5. It's a 5-day, 5-minute chart. Map out the volume profiles. We do have an untouched value area high at 41.88. In the grand scheme of things, I don't anticipate that it's going to provide much reaction in the market, considering all the things that we could mark. But, and this is often why I don't carry forward value areas, it lines up really close with a high a day value. And since I'm more focused on open, high, low, close, previous day's high, previous day's lows, close, I'd rather lean into that than focus on a value area. It doesn't mean that I'm right or wrong, just, there's so many pivots. This is an example of the pivots that I keep on my screen, and as you can imagine, I've already got enough. Now, they look, it looks a bit extreme, zoomed out like I am, but once we're in the intraday and I'm running on, say, a 4,500 tick, it's not that bad after all. But I've already got enough, right? It's kind of the point. There are some untouched point of controls to the downside if we should get extreme. There's a virgin point of control at 39.27. Another one at 39.75. At 40.73. And I got those by running the 5x5 map, only instead of using just 5 days, I went back even farther than that. Generally speaking, you want to kind of keep them on your chart. That's why I save them on different drawing layers, so I can turn most of it off, right? And then I don't have a cluttered chart unless I want that cluttered chart. So if we start backing up the value areas that were marked, come from back here, right? An untouched point of control very likely will be a place where price responds. That's why you want to keep track of where they are. All right, so we're out on the daily chart here. When you look at the market maker move and the ADR that I've got on the screen there, you can imagine how extreme or how drastic today's movement is likely to be. This is what we've been doing for days now. The ADR keeps track of every day, right? And it's counting every day. Well, our ADR has shrank drastically over the last week and a half because the days have been very, very small. So the ADR that we're using in today's measurement really doesn't give us a lot of the true sense of the move today. If it had been a lot of ADR days that looked like this day back here, say if we had 21 of those, then our ADR would be much bigger than it is today, right? But we've got, like 9 of these really small days where IX10, we're looking for an inside day breakout with IX10. We've got the potential for a TRP to the downside. This is shaping up to be one of the pivotal pieces of the puzzle between now and September. What the market does with the ES, it's very likely that the rest of the market is going to do today. That's an important piece to keep in mind. 8 out of 10, 7 out of 10, that's a reasonably decent correlation coefficient. Today, the real danger comes in if we get a high correlated coefficient. We're talking 99, 98 names out of 100 in the S&P, or 98, 99 names in the NASDAQ. This is why I built the Alpha Protocol program. When you're running in a high correlated coefficient, you don't have to worry about being a stock picker and going in and trying to decide, well, should I get American Express or should I get Visa or should I get MasterCard? Get them all. Should I get Bank of America, Wells Fargo, or JP Morgan? Yep, get them all. Buy everything. Whether that's buying puts across the board or buying calls across the board, you buy like an algo would. You buy everything in the basket. You'll know really quick if you have any name that stands out that's not participating in the crowd. You kill that name off as fast as you can, keep the rest. Now, obviously, if you're going to go start buying calls in 40 to 50 names, this is not a small account strategy. The Alpha Protocol program was developed based on what algos do. That's exactly what they do. They sell the basket, they buy the basket, they trade the basket. We haven't had many opportunities this year to run the Alpha Protocol program because, as you can imagine, a very high correlated coefficient doesn't happen every day, which is kind of nice, right? Because then when it does happen, it really stands out. It's something to consider to put your own watch list together. Obviously, you wouldn't want to trade my protocol list. Probably has names in there that are bigger than you want to trade, or maybe smaller than you want to trade. They might not have the liquidity that you're looking for. So you got to make your own list. It's a good place to start is with liquidity, that it needs to be liquid enough that you can easily get into it and out of it. Because we're talking about an extreme day. If the market doesn't like these numbers, we're very likely going to retest 38 and then 37 in the next 2 weeks. On the other side of that, 43.50 is not out of line in the next 2 weeks. Not quite sure about 4,000. I've heard some talk on that, but that seems a bit much. But 43.50 is not out of line. So we've got our cup. Not quite a handle. We may not get one, or the handle may even appear above the top of the cup. More like a ladle or ladle. Some confirming signals that we're going to want to see today that it's going to stick, that we're not going to necessarily reciprocate back, is a continuing fade in the dollar. If we talk about the S&P making a big move to the upside, we want to see that dollar really sell off, get below the, say, 105 level. I'd like to see it below 103, honestly. Get the VIX below 21. Continue to see oil below 90. It doesn't necessarily need to sell off, just not rally. And I want those bonds below 140. See some drastic moves. I want clear, clean, unmuddied data, right? No gray area, no shades of gray, no ambiguity. We want it very clear, very clean, very convincing. We've been using Bitcoin as a risk-on gauge or a risk-on sentiment. In this pop, should we move to the upside when the numbers come out, we want to see that money moving into Bitcoin as well. Otherwise, the fear is that we make a drastic pop, say to the upside or the downside, and then we reciprocate. We spend the morning fading back down to where we popped, to where we broke out, right? Or to the downside if we happen to dump really hard with the news, then we spend the rest of the morning reciprocating, moving back up. So we want to look for those confluence signals in the bonds, in the dollar, in the oil, in the VIX. We could go through looking at some stock, but I mean, honestly, it really just comes down to the numbers. At the end of the day, it's what we got to have those numbers before we do anything else. And what I would recommend, if you want to kind of game it, think about it in advance, is go out and pick the names that you're really interested in trading and measure out that market maker move and the ADR. Google, for an example, has a market maker move of 1.65%. It's a pretty extreme market maker move. It's got a 2.8 ADR. It's a 2.8%. So you're looking at about $3.30 from the ADR and then $1.93 from the market maker move. You would add those two together. So like $21, $22 move, or $1.21, $1.22 in Google, or down to say $1.10. $1.10 wouldn't quite get us down to that low, around $1.05. But a topside play would get us pretty close to this FOMC, the May 3 FOMC announcement high. By gaming it out like that, you can go in and start pricing the options that you would want to trade. If we get bullish, buying the calls at the target where you think we're going to go is going to be cheaper than buying the at-the-money calls. Doesn't make it right or wrong, right? Usually buying out-of-the-money calls leaves you exposed to the idea that you really need a move. Right? If you get the at the money or the in the money calls, the move doesn't need to be so extreme for you to start seeing profit. You get that out of the money stuff, you really need the market to move. Well, this is the kind of day where you really could see a market move. Same thing with the put side. If you think we're going to be bearish, go in and start thinking about, well, which puts would I buy? If I thought it was going to go to 110, I'd be wanting to buy the 110 puts. Now, the deal is we're going to make the move before the market opens. So then you got to be focused on, well, what option would I want when we get into the open after we've already made the big move from the report? It's my day to stream. I will be in the futures around 9:15. And I'll see y'all there.